In 1954, Rockwood & Co., a coca beans company, was liquidating his company by giving a pound of beans against one share of the company. Due to the shortage of beans, the price of beans went up to $36, which was more than the share of Rockwood, which was $34. A clear $2 of profit. That was one of the early trades Buffett did. Normally, the trades used to be buy the companies, whose stocks were trading under their assets' value, and then liquidate the assets to make profits. The strategy was good, but was very limited. You would rarely find any kind of stock which is trading lower than their assets' value. The trade need to time well, as with the Rockwood, he also shorted beans, which was very risky. Now, anyone who has heard Buffett know he wouldn't like these kinds of trades. So he turned his strategy around something much bigger. Warren Buffett started buying insurance companies like Gateway Underwriters Agency, General Re, MedPro Group, National Indemnity Company, and most importantly Geico. So why insurance companies? Well, insurance companies are not like hedge funds or banks, but better than them. If you compare, hedge fund take your money for a short time, and keep around 20% of profit. Bank, keep 100% of the profit, until you take it back. Insurance, keep all of your money, forever. Insurance work very differently from other financial services. In short, an insurer takes premium from the customer and keep it until the customer claims it. Until then the money is lying down with the insurance company doing nothing. These called as float. Insurance companies are allowed to invest this money to make profit. It's like a loan without interest. This is the primary source of profit making for most of the insurance companies, including the subsidiaries of Berkshire Hathaway. Berkshire Hathaway float has been increasing through the years, from 39 million in 1970 to 91 billion in 2016. So if Berkshire Hathaway can invest and make a $200 billion portfolio, why are not other insurance companies are doing so? Of course, they don't have the greatest investor. But still they don't work as Buffett does. Back to the insurance, the premium you pay to insurance is not always paid as claim. This is called as underwriting profits. The other side is also true, when the claims exceed the premium, which then is called as underwriting losses. Berkshire Hathaway is very good at underwriting. One of the good example of it was, in 2003 Pepsi ran $1 billion sweepstake contest. The show was aired on WB with 100 people participating with 1 in 1 million chance of winning $1 billion. Still, Pepsi don't want to lose $1 billion, so it insured it with Berkshire Hathaway for $10 million. At the end, no one got the $1 billion, but Berkshire enjoyed in premium. Most of the insurance companies invest their float into mostly in bonds and a very small part of it into equities. Why, then, is Berkshire Hathaway allowed to invest in stocks? Foremost, every company doesn't have as excellent cash flow as Hathaway. It owns US's one of the largest utility and railroad companies, and a bunch of other well-selected businesses, and consistently making profits for years. That's why investing float in stock by Berkshire Hathaway is less risky than other insurance companies. Warren Buffett has been very good at using float for a long time and has become very good at it. Of course, that all wouldn't work if he wasn't that good at investing.